Good morning, good morning, good morning. Okay, welcome. Good morning, good afternoon, good early evening. I don't know where you are at the time that you'll be taking in and participating in this particular broadcast. But this is Capital Bootstrapping 101, and I am Dr. Stephanie Ardrey. I am here today with you to share this presentation and information because during this time where we're experiencing a global pandemic around the world, there are certainly companies that are facing major financial turbulence. At the same time, there are opportunities available to recast your business fortunes, recast your financial possibilities, but it all comes down to really what you understand. And I've spent the last 30 years in business and definitely have been on the forefront of training entrepreneurs on the strategies necessary to succeed in business. The last decade following the Great Recession, I made it a point to really focus on everything capital, really becoming an expert in capital. So much so, I earned my Doctor of Business Administration degree, and my doctoral dissertation was on uh, venture capital because it was important for me to provide venture capital for a particular audience. I focused on venture capital for independent filmmakers. But when you go about speaking about capital, capital is important and essential for all businesses. And so it's just a matter of understanding the fundamentals. So this presentation today is going to walk you through what I call my Capital Bootstrapping 101. As I mentioned, I'm Dr. Stephanie Ardrey. I'm the CEO of Blue Diamond Group, Inc., which includes Blue Diamond Advisory. And this is where I help companies in the early and SME space with addressing three things: capital, capacity, and customers. And this is so that they can really understand how to set forward strategies that will allow their businesses to grow and prosper, and really be prepared irrespective of the business cycles. Blue Diamond Capital is a commercial brokerage, and through that firm, I assist companies with commercial finance, commercial real estate transactions, and business brokerage. So, for entrepreneurs who are contemplating exiting a business and wanting to understand if that business is going to have a certain value at that time of exit, I like to say the best time to plan an exit is to begin at least 3 to 5 years. I prefer 5 to 7 years, but if we're getting down to the end, let's at least have a 5-year mark so that we can evaluate what an exit might look like and then determine strategies. I had the opportunity to have that conversation with one of my clients about a year ago. And in having that conversation with him, we discovered a similar thing, that he would love to exit his business in about 5 years. And he would love to walk away with about $5 million in his pocket. But when we began working together, his company was doing just over about $500,000 in revenues. So we decided to map out a plan that would allow us to think about how we could get him to that ideal exit point. And in doing so, we created a new division in his business that we've had to capitalize, meaning we've had to go out and find additional debt resources so that he could finance this business expansion. We've had to develop new sales teams because we're launching a new division for him. And then we've also had to identify the customers who we believe would be most interested and willing to participate in those opportunities. Participants, could I ask you to please mute yourselves in the background? I'm getting a lot of background noise. So would everyone please mute? Thank you. Thank you very much. We're broadcasting live as well on YouTube, so I appreciate that. And so anyway, so by looking at his business and thinking about where he wanted to exit, then we've gone backward and put together a plan. And already, just in the first year of working, we've already almost tripled his business revenues. So we're closer to about 2 million in about a year and a half, whereas we were only aiming to get somewhere between 5 and 7 million in revenues for him to exit at his desired exit. So we're going to more than meet his outcomes. And we've also set up strategies so that when we sell his business, we sell it in a tax favored manner so that he's able to realize more of those gains rather than having a huge tax liability at that point. But anyway, that kind of lays the foundation about how I work with some of these companies and make a determination about where they want to go and why strategy is so essential. So a little background about myself. I've been covered and continue to accept opportunities to share information out in the marketplace. I've worked with a bunch of clients. You know, you figure after 3 decades of business, you get an opportunity to have a number of opportunities. And so our agenda for today. So our learning objectives is for you to walk away with a better understanding about capital. I want to be able to help you come to a point where you understand your funding goals. And really your funding goals are based upon understanding where you are in your business. And so the sort of quick and dirty way of coming up with that is by looking at what is your situation? What is my current situation? Am I starting a brand new business, or am I in a business and something has happened that requires me to pivot or reposition my company for growth? Is that what's happening at this particular time? And so what you want to do is, under that situational analysis, is think about what is the current market situation? And then what you create following that is a SWOT analysis. And a SWOT analysis allows you to take an internal look and review of your organization, as well as looking outside. So for example, the S&W are for strengths and weaknesses. And the way that I like for entrepreneurs to consider the strengths and weaknesses is to consider the functional domains within your organization and evaluate how strong or weak you are across those particular functional domains. And then external factors, opportunities and threats. What opportunities have been presented in the marketplace that you can take advantage of? And then what threats exist in the marketplace? So many companies, we were not prepared for COVID-19 and how that would disrupt our businesses. I know in my lifetime of being in business, I've never experienced the US shutting down. So this was a completely disruptive experience. And if I had not been planning for a virtual component to my business, then I too would have been hurt to a greater degree. I mean, my company definitely was hurt. If you were operating a commercial brokerage and you're doing tenant rep, you're meeting people, taking them and showing them properties. And if an entrepreneur had not secured a space pre-COVID, many of them were not looking to commit themselves to a space because there's too many uncertainties regarding how long this may last, you know, what the information issues might be. So that created a disruption to that part of my business. But thank goodness I had already prepared to really start launching Blue Diamond Advisory, because I felt that so many companies were still struggling to regain traction. And then with the SBA providing access to both an EIDL loan and the PPP loans, I had an opportunity to really attempt to help clients on their commercial finance requirements. And so in doing that, that then began to reveal some of the gaps in so many organizations. So not everyone who should have taken advantage of those opportunities were able to take advantage because they weren't prepared. They didn't have their paperwork in order. They didn't have a plan about how they were going to keep their employees safe. They didn't have an idea about how they would incorporate technology in their businesses. And those types of things caused a little bit of a hiccup. And because the funding was time sensitive, unfortunately, some businesses were not successful. So the next thing that we talk about is a vision and mission. And so oftentimes, again, these terms have been used interchangeably. So I like to establish my vocabulary, our vocabulary during this presentation. Vision is where you're looking forward. I like to look at 5, 10-year increments and think about where is it that you see your business going? How would you like your business to look and be in 5 and 10 years? The mission is dynamic, and the mission is how you're going to get there. So the mission ends up evolving as you accomplish specific business milestones. So you want to keep that in mind. That mission is sort of the how we are going to behave as an organization as we're setting out to accomplish our milestones. And those milestones are what are aligned with the overall destination that we're looking to manifest. And so when we talk about funding, we're looking at both debt, and then we're also looking at equity. And then I've saved some time at the end for Q&A. All right, so let's jump in. So when I talk about this, the importance of this vision and the mission statement, here you see it again reflected in the foundational process to set up a strategic plan. You've got that business mission, your SWOT analysis, again, you're looking internal to your organization, you're looking externally, and to the degree that you can plan for what ifs. I like to tell people that the reason that I plan the things that I can plan is that it leaves me the space for those things that I could not have possibly have anticipated, because they're then going to require a little bit more time. And it might become a time sensitive requirement, much like the COVID created for entrepreneurs. I would not have been able to pivot as quickly as I did if I was not working with a strategic plan that was saying, okay, it's time to add these additional elements, it's time to expand and to ramp up the technology, to add new tools, to make those investments so that at a time of need, all of those things are already in place. I didn't have to spend as much time doing the research to determine which tools were going to be effective for me as I began to transition to the secondary company, Blue Diamond Advisory, where I began to take on advisory clients. And I bring that up because it's interesting. When we went on complete lockdown in the US, I found myself working from my home. And I was in the process of opening up a second office. My office is based in Newport Beach. I was just in the process of opening up a second office in Henderson, Nevada. But thankfully, I hadn't signed the lease yet. Amazing. So I didn't sign the lease. So I didn't become committed to a space that I would have been questioning. And by not doing that, what working remotely allowed was for me to start thinking about what else I could accomplish by working remotely. And in that, I decided that it was very important for me to take some time away from my normal environment. So I left Vegas in August, went to New York for 3 weeks and had an opportunity to be on the ground and work in New York. And then I had made plans to go to Jamaica. I've extended my trip in Jamaica, I think 3 or 4 times now. I've been here now 2 months, and my last extension will finally complete in another 3 weeks. Everybody believes that I really have moved here to Jamaica. And believe it or not, I have expanded my business opportunities. So I will be spending a lot of time and maybe even relocating for significant portions of the year here to Jamaica because my mindset was set. I was able to come and resume relationships that I'd begun some years back, but also find new opportunities that I could capitalize on right at this moment while this economy and others are looking for strategic ways to rebuild. And so when I talk about the company value chain, and a lot of times right at this point of my presentation, entrepreneurs are like, wait a minute, you're talking to us like we're a big business. I'm a solopreneur. I don't have a full team that's working with me. Listen, I'm telling you, you want to understand this company value chain because this is the process that you're going through to get your product or your service from concept to your end user. And so you may not have internal staff who are performing these various functions. You actually might be wearing most of the hats. But what you want to keep in mind is you want to plan your profit formula so that your profits could sustain a team so that as your business gains market traction, you can begin to fire yourself from these other jobs so that you can hire competent people to fulfill those roles. Again, whether they're internal or external is not the point, because what happens is when we're talking about capital, I see so many businesses fail, and it's because they're undercapitalized from the beginning. Secondarily, the reason that they're undercapitalized is they never considered what the cost would be to be able to have competent people advise them or work for them in different areas of their business. So they've underpriced their product or service. So even if they get an opportunity for growth, they cannot sustain the growth without shifting, either making a significant change with their pricing structure, which means that now you've changed potentially the value proposition that you've promised to your market, or just discovering that there's a shortfall. And so that's why it's so critical to understand these things. And even though you think they don't immediately impact your business, prepare for them because they will. And that's why you want to at least have put some thought into it. Okay. This next slide is when I'm talking about a business or product life cycle. And every business and every product or service in your portfolio goes through its respective life cycle. The lower S curve is my illustration of a business that's financed using its cash from operations only. And the larger S curve is my illustration of a company that is benefiting from having access to additional capital to help support its growth over a period of time. And the distinction that I'm attempting to make is this. Some of you have a cash and carry business, which means that you don't have to invest a lot upfront per se, in terms of inventory and things of that nature, but people pretty much are paying you pretty quick or pretty close in sync with your point of delivery. But that's not the case in all businesses. You know, when I think about my commercial brokerage, that is a business that has a long sales cycle and a long carry period. Because in a brokerage type business, you're not compensated until you successfully consummate the transaction on behalf of your client and that transaction closes. So think of this. I had a client that wanted to open up a coffee shop, and we started looking at different locations that would meet her criteria. But she was really, really specific on what she wanted. And she was changing careers, so she really wanted to go slow and take her time. It took me a year to close on a lease for her. And then once we found the space, it took about 60 days to negotiate the lease and get the lease closed. And then it took another 30 days after that for me to receive my compensation. So imagine that. That's like almost, that's 15 months of waiting to get paid. Now, over the course of that 15 months, my operational costs didn't go away. I still had to pay for my office. I still had to pay for all my tools. I still had to pay for everything to continue to operate my business. So if I didn't have access to either credit lines or other type of capital, then it would have been impossible to support a client who was not able to immediately make a decision regarding securing their space. And so you want to be able to anticipate those types of opportunities or realities. I owned an advertising agency, and there were clients that wouldn't even allow you to bid on their business if you could not finance your operation. So in that experience, the clients didn't pay for 6 to 9 months because you'd have to develop the creative, you'd have to place the creative, do all the media buy, then you have to wait for documentation from the various media that you've placed to confirm that you actually placed the media, that the media actually aired, and then present that to your client. So 6 months. But I had a full staff, and I had to meet payroll twice a month. So I had to have other ways to finance my business so that I could meet payroll. And I think as an entrepreneur, when you're meeting payroll, you can't miss payroll because your staff, they will lose faith in your business because they'll be concerned. They're not you. They're not the entrepreneur. They're working for you. So they expect for you to have some continuity in delivering, their paycheck. That's what they signed up for, is a steady paycheck. Okay. So now I want to help you see through this illustration the relationship between strategy so that you kind of understand why I'm harping a little bit on strategy. Strategy, basically, in a nutshell, says, I'm here, I'm trying to get there, and this is how. So it's the how you're going to get to the destination. And so what you are doing is you're determining and formulating competitive initiatives. How are you going to compete in the marketplace? Either you're in the marketplace and you're competing with an existing set of businesses that offer a similar solution for your clients, or you believe that there's a new market opportunity and no one is exactly providing that opportunity. And so you believe that there's going to be expansion in the market for your new solution to get to market. Either circumstance is a strategy, and they require different approaches to successfully accomplish those goals. If you're building a new market, then you have to anticipate that you have to first educate the market sometimes before you have a market willing and ready to invest dollars in your business, because they don't know, they're not familiar. They weren't aware that they had the problem that you're trying to solve. I do a deeper dive on that in the marketing strategy workshop that I produce. So look out for that, because it really builds upon helping you understand marketing from a strategic level. Before this conversation, we're going to suffice it to say, you understand this bigger strategy, you identify your competitive initiatives, and then you formulate your business approaches, how you're going to go about approaching business. And then with that, you form the value proposition, making sure that that value proposition is profitable. And so what I mean, let me give you a basic illustration here. The CEO of Walmart and the CEO of Nordstrom both are operating in retail spaces, but they each offer a different value proposition. And so because they're offering a different value proposition, then they manage how they allocate their resources a little bit differently. So you don't go to Walmart expecting to have outstanding customer service, because that's not the value proposition that Walmart promises. What Walmart says is that we are going to provide you with the best value in terms of your purchases for your various retail household goods. And so what that means is, as a CEO of Walmart, my investments are in making sure that I have a supply chain where I can buy at a sufficient level of scale so that I can then negotiate the best prices so that I can then pass that on to my customers. So that's their value proposition. And so their focus is on those things, the logistics, the warehousing, minimizing operational costs so that they can deliver that lower cost value proposition. If I'm the CEO of Nordstrom, I've promised that you're going to have an amazing customer experience. So it's important for me to have the best sales associates on my team and to empower them with the tools and resources and abilities to make decisions. So when you walk into a Nordstrom's, you're going to experience whomever you come in contact with as a sales associate who's going to make sure that you have an amazing experience. They don't care where you came. You could walk in the shoes and connect with someone, and that person can guide you throughout your shopping experience because it's more about having you have an experience, an amazing customer service experience, a seamless experience. And even there's legend about a customer returning a set of tires at Nordstrom's that Nordstrom's never sold, but they took the tires back. It's like, really, why? But it was about delivering this amazing customer experience. And in business, cash is king. And so oftentimes when I'm working with a client, what I realize is that there's so many assets within the organization that have been misallocated. So you may say, okay, we need another $200,000 to support our operations for the next 12, 24 months. But a lot of times what I find is if I go internally and look at the allocations that you've already made, I can find some of the resources that you need internally by creating efficiency. So that came up recently with the same client where I'm expanding his business. We're closing on an SBA loan. And we projected, they wanted us to project into next year the client's growth. Hey everyone, could I ask you to please mute yourself? I'm getting a little background feedback and we're broadcasting live on YouTube. Thank you so much. So I asked this client so the underwriter is looking at the projections and they specifically come back and say, wait a minute, you show how there's going to be a growth of X amount over the next year. But in fact, your operational costs are going down by 6 or 7%. How is it possible for you to grow and reduce your operational cost at the same time? And my client got to have an amazing learning opportunity because I said, first of all, I evaluated my client's business before determining what capital we needed. So I went in, we updated the technology, I did training for the team, and we reduced the waste in his processes. We took out redundancies. So we made his organization as it is right now more profitable right now. So then now when we grow and add these additional clients, the top line, you're going to see some of that top line actually get to the bottom line. It's not going to be absorbed by an increase in operational expenses because sometimes that can defeat the purpose. Just because you increase top line, if you can't manage the operational costs, then you're going to continue to spend more money. And when you look at your bottom line, it might not be what you want it to be. So it's important to kind of keep that in mind when we're talking about this. So cash is king. And the importance of cash, because sometimes people forget that really at the end of the day, cash is like the fuel that operates your business. So you're trying to find it, raise it. You're attempting to conserve it. And then you want to make sure that you're collecting it. A lot of times people have outstanding accounts receivables. And that was another thing with one of my clients. He had accounts receivables that had been sitting on his books for 9 months. And I'm like, what are you guys doing to get your money? Get your money. You don't have the ability to finance this big old general. He's a fire safety contractor. You don't have the resources to finance these big major clients that you're doing work for. They have the ability to get the capital, make them pay your bills. You're not the bank. And sure enough, they started to get their money. And so when we talk about financing a business, I always say that it's important to use a layered financing strategy, meaning that everything that your business needs should not be financed in the same manner. So what I usually do is when we're talking about your capital requirements, I'll have you put together a use of funds summary. And what that is you basically say, okay, we need $200,000. Okay, how are you going to allocate those $200,000? And I'll look at the list. Oh, we're going to get technology. We need this equipment. We need XYZ. And then I start going through that list and determining what source of capital should be utilized for those various needs. So if you need equipment, you don't use your cash on hand to go and pay for equipment. Equipment can be its own collateral. Absolutely use debt because you need cash for things that it's not as easy to find other ways of getting. When you're trying to get just working capital, if you don't have a big portfolio of collateral, then it's going to be challenging sometimes to get access to that working capital. So you want to make sure that you have the cash reserves for those things that you absolutely need cash for. Everything else, you want to use other types of capital in order to finance them. And so there are three types of capital that I'm speaking about. This is initially your fixed capital. And what your fixed capital includes are the capital that you're using to buy permanent or fixed assets for the business. So if you need a building, if you're looking for land, if you need equipment, those types of things, that's what you're looking for fixed capital. And so when we talk about that bucket of capital, one of the sources for that type of capital is the Small Business Administration, it's SBA. So I like to use the SBA for fixed type of capital because the SBA will help you with also helping you to collateralize the funding that you're seeking from the lender. The next bucket of capital that you need is working capital. And this is where you're trying to maintain the cost of your inventory, you're paying your regular operational bills, wages, salaries, those types of things. And so the working capital sometimes can be a little bit more challenging. And so one of the ways that I've been educating entrepreneurs is making sure that they've structured their businesses appropriately and that they're building corporate credit and corporate trade lines to support their business so that they have a little bit more flexibility. I like the saying of, I want to make a dollar do 5 to 10 jobs. So every dollar that I have, I want to maximize what that dollar is doing for me before it leaves my organization. And then lastly, it's growth capital. So if you're trying to expand or change or add, pivot, which is a lot of what's been going on as a result of this COVID environment, then this is where you're looking for growth capital. And so a lot of times I had one entrepreneur saying, well, I want to launch a new business, but I don't want to go into debt. And so I'm like, well, okay. Do you really want to launch the new business? How are you going to take care of the opportunities if your income has been disrupted? Then that means now you've got to go and figure out how you're going to finance the growth, or you're not going to realize any growth because you're not going to be able to have the resources that you need as opportunities are presented to you. So it's really not an entrepreneurial mindset. It's more of a, I'm an employee mindset and I don't want to go into debt. When you're in business, business is fueled on debt. No, I'm not telling you to be overextended in debt, but you need to understand that business is about growth and being able to take advantage of opportunities. And that means having access to capital so that you can advance your business objectives. So funding, yay, funding. Equity capital. So equity capital includes the personal investment that you're going to make or the owners are going to make in the business. It's risk capital because basically it's all at risk, There are no guarantees that when you invest in a business, that that business is going to succeed. And sometimes you can have top shelf A players with great intentions who are well capitalized, and those business fail as well. Because it's not just about the team, it's not always just about the business plans, but it's about the market response. And if the market is interested in what you believe you're bringing to the market. Equity is not repaid on a fixed interval, usually, like debt capital, but depending upon who has provided that equity capital, there is a desire for some type of return. If you're using your money, you are expecting at some point that your business is going to be able to either be sold, acquired, or something. And collectively, that is going to return you a return on your overall investment. But if you take in capital from outside parties, you have to realize that they're not necessarily interested in being in your business for the duration. So when you talk to investors like angel investors, they're usually working on about a 3-year interval. They want to get their capital, their money, into the business and out of the business in about 3 months with some type of return. And so you have to plan for that by articulating some type of liquidity event. So when we think of equity, the sources for equity, again, owners, the 3 F's, we like to call those the friends, family, and fools. We don't, those are the folks that love you and they're going to support you because they can, they want to. And then the last bucket includes angels, high net worth individuals, family offices, VCs, and or institutional investors. Now, unless you're building a business that you see yourself getting up to 10, 20 million, and you have a horizon, 100 million or something like that, you're not going to fool around with going after family offices, VCs, or institutional investors, because they're looking to enter your business when you have somewhere north of 10 million in revenues, just as that's the floor. And then they're going to help you scale up so that everyone can realize some type of exit. The angels and the high net worth individuals, and sometimes high angels invest individually, sometimes they syndicate and invest as a group to support a particular business. Okay, so debt capital. Debt capital must be repaid with interest. It's carried as liability on the company's balance sheet. It can be difficult to secure in the beginning. And the reason that it's difficult to secure in the beginning is because too often entrepreneurs are going to the wrong source. You're going to a retail bank because you had a retail bank account, and then you decided to start a business, and you go ahead and open up a business account with that retail bank. And yeah, they're going to take your money because they're making money off of your money, but they're not necessarily going to support your business. And that's a problem, because if you've kept your money in a retail bank, I literally just talked to a client a couple days ago, and he's like, oh my gosh, we had a business situation. We need about $200,000 in debt. So I asked him, send me a summary of where his money is. Send me an updated balance sheet. He sends me a balance sheet, and I look on his balance sheet, and I had convinced him to establish a banking relationship with a business bank, which is how he was able to successfully get his PPP loan. And because the retail bank that he was doing business with, Bank of America, he didn't get an opportunity to file or receive his PPP through that bank. But for some reason, he took all the money out of the business bank, and all the money is sitting over in Bank of America. Now he needs a $200,000 loan. Bank of America is not willing to make that loan. The business bank would have made that loan. We're closing this week on a $220,000 loan with the business bank with another client. This other client could have been closing on the same financing for his business, but he refused to adhere to the lesson behind why I've been saying it's so important to diversify your banking relationships and to have business banking relationships. They're in business to support business. You're not just a number like you are when you're dealing with a retail bank. You're not going to be on B of A's radar until you're already somewhere north of 10, 20, 30, 40, 50 million. If you're a little small cat, you're just a number for them. They're not interested. They'll give you debt if you bring them collateral. So if you have your house that you can use as collateral, okay, you might get a loan. But in terms of merit based on your business, you're wasting your time. And oftentimes, what entrepreneurs do is they wait too late. You wait until you need the money to go and try to get the money. That's not how banks work. You build the relationship. It's like you build your well before you need it. And so that's so important to do. So, debt can be acquired through loans. Oftentimes, you need some form of collateral. You can use different things for that collateral. It could be dividends if you have some type of consistent income stream that's coming from a source of dividends or royalties, or if you have a 401k or some other type of retirement program, or if you have insurance, whole life insurance policies. Many times they serve as collateral to assist building up your balance sheet so that you're able to get the financing necessary for your business. So really, the secrets to successful financing is about understanding the right source that you need at the right time that you need it. So many people tell me, oh, it's so hard. I'm like, there's so much money out there. You're just not prepared and you're just not looking at the right places. And this is why you're having difficulty securing those funds. And if you're going to be pursuing equity, another misnomer or mistake that's made is that an entrepreneur believing just because you're in love with your business doesn't mean that when you run out to an investor, that they're going to fall in love with your business and that they're even caring about the business. What the investor is looking for, what is the risk profile of me writing this check for your business? So if I write you a check for $50,000, are you going to lose my $50,000? Is it better for me to put my $50,000 in a CD, invest in particular stocks, shares in a publicly traded company where I'm going to be able to at least monitor the markets and then have some understanding about what that risk profile is? Or am I investing in someone that really is capable of understanding that in about 3 years, I'm going to want to see some type of return on my $50,000 and I want my principal back? So how are you going to accomplish not only getting my money in your organization, how are you going to allocate those funds, and how are you going to return my funds back at what point of return for me? And then how does that equate based upon the risk profile and the other things that I have available to me as ways of allocating my funds? So you have to understand what the investor is thinking about. They don't care about your widget, truthfully, at the end of the day. But investors do invest in particular asset classes based on their knowing and understanding of those particular asset classes. So you don't want to talk to an investor that is familiar with technology about a retail-driven product if it's not based on a technology, because they invest in technology because that's what they understand. So you need to be able to talk apples to apples with your various investors. The next part of funding is being creative. So for example, I tell people how when I was in advertising and I needed to find ways to continue to capitalize my business to continue to grow. So I structured a joint venture. And in structuring the joint venture, what my minority shareholders and investors had was they built a a model where they capitalized the billings from multiple offices. We had 8 offices across a region. And we were able to capitalize our billings and use that for leverage to be able to get debt capital and to be able to have lines of credit that allowed us greater flexibility. I indicated how if you're dealing with big corporations like our automotive group, the Ford account, we might get paid in 6 to 9 months. So we had to have an ability to meet payroll and keep our employees going, doing the work necessary and placing those media buys. And so if we didn't have the type of credit lines that we had, then we wouldn't be able to place that level of media buys, which means we wouldn't have been able to qualify for those bigger accounts. So when I structured the joint venture, I wanted my minority shareholders to put some cash into the venture, but I also wanted them to use their credit lines to back my new company. And so they gave me a huge, leap forward. So instead of me starting at a smaller place just based on our billings, we were able to benefit from all of the billings, and that allowed us to make more money faster. The internet has a lot of resources at your fingertips. So make sure that you do your homework. It's so embarrassing to have entrepreneurs come in to either pitch or to come into the wrong organization looking for capital. And it's so clear that they just are ill-informed. And that's why they're not going to be successful. So you want to make sure that you're informed and understand the different ways and being prepared. You want to understand what asset classes. So if I'm dealing with a lender, a commercial lender, do they lend in my particular asset class? Or is their portfolio capped? And so what I mean by that is every lender has to carry a certain ratio of capital to their lending. And so they'll diversify their portfolio of the types of loans that they're going to make. And then when they hit a threshold, they're unable to make any additional loans in that particular asset class until they rebalance the portfolio, create some type of liquidity event so that that portfolio is now better balanced. Then that frees up additional runway to make additional capital available. And so this is why when I'm speaking with entrepreneurs, I stress the importance of having, I like to say my fave 5. Remember there was a internet commercial, a cell phone commercial about your fave 5. I say you want to have 5 banking relationships that invest or lend in your particular asset class, because one lender might be capped, but the other lender is not. But if you build those relationships, you're going to have them and they're going to create better opportunities. And so one of those situations, I remember when I was expanding my business from the Bay Area, I was in Oakland, I was moving to LA, and I've been going to, the branch that I found in LA that was an extension of my relationship in Oakland. And I would, the VP, he would see me come in oftentimes. And one particular time I was in the branch making some deposits and he was like, "Hey, how you doing?" I'm like, "Oh, well, everything's great." And he says, "Could you use a line of credit?" And I was like, "Yeah." He says, "Okay, if you want 25,000, I can sign off and approve it at my level. If you want more than 25, then it has to go above me." So I said, "No problem. I'll take the 25, sign that, and great." So now think about that. What if 5 other of my banking relationships had that ability to sign for 25,000 at their level? Now I've been able to get that 25 from 5 different sources. I didn't have to just be focused on, oh, I need to get 100,000 from this one bank. No, be creative, be open, understand what the banking relationship is willing to do. For several people who have served in the military or have a family member who has, Navy Federal is one of the credit unions that had been offering for business entrepreneurs pretty much at the start of the business $25,000 and $50,000 line of credits just because your business, and you open up your business banking account and you applied for it. Of course, you began to set up your Dun & Bradstreet profile to show that you are a business that's going to be a growing concern and you're building that type of capacity. So, kind of understanding those elements. For people who are looking for seed capital or this equity capital, the disappointing reality is that out of 99% out of 3,000 employees or entrepreneurs pitching for capital are not even prepared for the funding. And what I mean by that is the second you start taking a dollar from anyone beside the friend, family, and fools category, you're going outside of that network, then you need to have invested in a consultation with a securities attorney, because now you are selling securities. And that falls under the guidelines of the Security Exchange Commission. And so a securities attorney is going to be able to advise you on which regulatory guideline or rule that should be applied to your business based on where your business is, based on the amount of capital you are seeking to raise. And so they're going to assist you with forming a private placement memorandum, as well as discussing with you what a term sheet might look like and some of the conditions in a term sheet that you might be aware of when you're going through these conversations with outside investors. So you want to make sure that you understand this and you don't run afoul. Trust me, it's a sad day when people go to jail because they have not paid attention. But I have heard about, unfortunately, people finding themselves in trouble at a federal level because they failed to follow those guidelines. And you just don't want to be there when it's easy to avoid. So a lot of times what happens again in this raising capital process is that financing between 100 and 3 million, that's kind of a difficult number because you're too small for a lot of the larger fund sources, and you're too small. I mean, you're too large for some of the smaller fund sources. So like you may have outgrown the capacity of your friends and family if you need $100,000, $200,000. So you just need to be aware of that and understand how to diversify your relationships, because that's what it's going to come down to, is where do you have relationships? And don't wait until you're already in a crunch, because it takes time to raise capital. And so anyone can sense if you seem to be desperate and no one wants to put money in a business that appears to be at a state of desperation, because that means that the team was not planning appropriately. And if they're not planning appropriately with their resources, what makes me think that they're going to change their planning now that they've got an infusion of my capital? And I'm not able to donate money to you. If I write a check to you, it's an investment. So I'm expecting to get a return. And so I'm going to evaluate what that return should be based upon the risk profile of your business. So if you're desperate, then that makes me think that the risk is greater. Therefore, you're going to pay a premium on the capital if you're even able to secure it. So keep that in mind. And so, angel groups grew a lot following the Great Recession. And if you began to kind of research and understand them, there's over 250,000 of them. They've contributed over 26 billion. They've supported over 57,000 small companies. And usually they participate in kind of that $10,000 to $2 million needs range. And so kind of understanding who they are and how they make investment decisions is a better way of being informed so that you know how to prepare yourself accordingly. And so typically an angel, the average investment turns out to be somewhere around $50,000. Again, some lower, some higher. And they typically, once you have a relationship and they're really indicating that there's some interest, which means we're not talking about the time that it takes to build that relationship, but once an angel investor is saying, okay, let me kind of do a deeper dive, let me go ahead and begin a due diligence process. That process can take anywhere from 2.5 to 3 months to go from, okay, I'm kind of interested, so now let's take a deeper dive in understanding this business before you actually have a check in hand. So if you haven't anticipated that type of lead time, and if you haven't prepared sufficient runway, then you're going to find sometimes that you can't even get to the capital because you didn't prepare properly for the lead time necessary. Please mute yourself. I'm getting background noise. Thank you so much. And so some of the platforms that you could look at for where to find some of these angels, Gust is one of those that would be helpful for you to check out, F6S. And so the slide deck will be available. I'll tell you where to go to get that, and you can get these resources, angel.com. And so when you go to these different platforms, you'll have a better understanding of what's required in order for you to list your business and then be able to connect. Another source is looking at where business incubators and accelerators are active within your community. Because what these are sort of hubs where investors are looking for entrepreneurs, and then these incubators and accelerators are helping entrepreneurs become investable by going through the process of knowing what tools and things you need to have in place. And because the incubator and accelerator tends to have the relationships, they sort of help you as an entrepreneur create a warm connection with a particular pool of investors, and so that you can develop those relationships. And some of these incubators and accelerators have developed such strong reputations of delivering well-informed entrepreneurs that you have investors specifically just following each cohort. So I often speak and evaluate businesses for a number of accelerators, and then I have an accelerator, Innovation Venture Labs, which we're relaunching as a virtual accelerator early 2021. And the objective is to go back and rebuild a pipeline of 500 companies who specifically can get to 5 million in revenues within the next 3 to 5 years. And so that's a pool of entrepreneurs that I want to develop on the early stage. I'm working with another bucket of entrepreneurs who are preparing to exit. So those are the companies that I'm working with in my advisory relationship. And so this is just some of, again, the more popular accelerators and incubators, but do some online research and you'll discover that there are many out there, and especially around a lot of the universities. Many of the universities have recognized that they need to do more than just sell education. They really need to create entrepreneurial opportunities and help to facilitate those opportunities for students and even professors in some cases, and especially in engineering and scientific departments where you're creating new innovations that have an opportunity to be taken to market. You know, those are hubs where we're beginning to find more capital and more relationships. And then there's also crowdfunding platforms that formed following the Jobs Act, which allowed lower thresholds and additional regulations to make accessibility for outside capital a little bit more achievable for smaller organizations. So the same thing. There are a bunch of those. You want to familiarize yourself with them. If you're looking for capital that's below a normal lending threshold, then you might need a microloan, and that's a smaller loan, which is good for like working capital, inventory, supplies. Bank term loans are those fixed loans that operate over a longer period of time with a fixed interest rate. So if you want to understand where some of those programs and funding programs might be, a good resource is the SBA.gov. And so you can get an idea, and especially since COVID, they've been providing a number of tools and resources to help support with funding your business. Community development financial institutions. So again, these are CDFIs with a specific initiative and mission to support businesses that are typically not quite bankable. So you want to just be aware that there are other institutions that have a mission behind making capital available to small businesses. Oftentimes, people misunderstand what the SBA does. The SBA is not typically the lending institution, but in different cycles, depending on what's happening, they have become. So, for example, if you were applying for an EIDL loan, then the SBA, using dollars made available from the federal government, became a direct lender in that particular relationship. But usually the SBA serves as a guarantor behind the loan that a bank is going to actually issue. And so if the bank didn't feel comfortable based on what you presented as the collateral against the amount of capital that you needed, then typically you'll be directed to see if the SBA will step in as a guarantor, because then the SBA will guarantee 90% of the loan amount, which means now the bank is not taking 100% risk on lending you those funds. They are only at risk for about 10% of that loan amount. But mind you, if you're going through the SBA for financing, it requires time. We're finally about to close this week on an SBA loan for a client of mine. But sadly, it's taken about 4 months to get through all of the hurdles, to get all of the approvals, to finally get to loan docs, to finally get to we're going to close on this loan. And so many times along the way, if it weren't me managing this process for my client, he would have just thrown his hands up and walked away. But I had to continue to explain to him that not only do you want to stay in to the completion, there's a significant upside, because by closing this loan in October, the SBA is going to pay the first 6 months of principal and interest on his loan at no cost. So wait, you're going to get this loan, and what you would pay in principal and interest, you're getting a gift. It's going to be treated as a grant. I'm like, listen, you're going to get to the finish line on this loan. There is no way I'm letting you walk away from this, because that's going to infuse capital in your organization. And in fact, it's going to offset a loan that previously he had that he paid an incredibly high amount of interest on, because he waited until he really needed those funds. And that lender took advantage. The loan fees were exorbitant. The payment terms were disruptive to business cash flow. Thankfully, we're refinancing out of that loan, and he's going to get a bonus. That in essence, everything that he spent on that loan, he's getting that back and then some. And then we've got equipment financing factored into that. He's being able to purchase 2 vans for his business, and we're able to include that in part of this process. The last few things, I see we're getting close to the completion of our time, so I'm going to go through these a little bit quick, but you must understand the financial statements. You need your balance sheet, which is a snapshot that basically on a given day reflects how your business is. It takes a look at your assets, your liabilities, and your owner's equity. And this is a sample of a balance sheet. Your income statement, also known as a P&L, a profit and loss, is basically, again, comparing your business, but it's more of a moving picture over a period of time. And so what it's looking at, the expenses versus the revenue over a period of time to help you understand if you're going to operate at a loss, or if there is a profit, even if the profit is not immediately realized, maybe it's somewhere in the future. So your net income is your sales revenue less your expenses. And that's going to give you a moving picture of where the business is going based on those variables. And so it sort of looks like this. Okay. All right. And then the last one is your statement of cash flows. And so that one is going to allow you to project out, 12, 24, 36 months. You want to continue to update. So when you're projecting what you believe your cash flow is going to be, we call that a pro forma, which means that it's my best guess based on some clear variables that I use to make these assumptions. And then I'm going to update these assumptions at particular intervals once I receive the actual financials. And so it's so important when you develop your financials to prepare notes to financial statements, because numbers on a page without an understanding of the assumptions that were made is basically junk. The numbers mean nothing. I need the narrative to understand what you were thinking and how you projected these particular opportunities in terms of your revenue growth. How did you come up with the operational expenses? Did you bother to do any research to try to validate those numbers? So you must have those notes to financial statements. And then this is my page that shows you the resources. We're not going to go through the ratios, but it is in the slide deck. And don't forget to calculate your break-even point. This is where you're looking at what it costs between your variable and your fixed cost and your ability to cover that over a given period of time. So typically you're talking about monthly. You want to make sure if my overhead is fixed and I need to cover that overhead each month, how many widgets, how many transactions do I need to close in order to successfully cover that overhead? So where you go to get the deck from today's presentation is drmoneyfreegift.com. It's www.drmoneyfreegift.com. Dr. Money Free Gift. And then also you see on the screen the information to my organizations, Blue Diamond Group, Inc. So there's Blue Diamond Advisory and Blue Diamond Capital. I mentioned both are located in Newport Beach, and the deck will include my email address as I have. And if you are interested in following me, you'll be able to do so at Dr. Money Free Gift and connect with me on social media. And then I'm so excited because I was in the process of pivoting, and I am launching Dr. Money Live, which is a weekly show that will go live December 16th at noon. It'll be televised on Apple, Roku, and Amazon TV. And for more information about the Dr. Money Live show, you can go to www.drmoney.live. And so that's www.drmoney.live. So with that, I would like anyone that has a question to feel free to unmute themselves and to ask their question. So do I have any takers? No? All righty. Well, then if I don't have any takers for questions, then I would like to thank you all for joining me this afternoon. I want to wish you well, and I look forward to seeing you again in the future. Oh, wait a second. I see something. I couldn't see my chat, so let me check real quickly. I see a chat note. I forgot to tell you guys, I'm in Jamaica, where I've been for the last 3 months. Oh, okay. Thank you, chat. Um, Mike. Okay, perfect. So anyway, where I've been for the last 3 months. And so I had an earlier live out on the balcony with the ocean background, but I wasn't so sure about this one. So anyway, again, thank you so much for joining me, and take care. Feel free, like I said, to email, find me on social media. And I look forward to connecting with you all soon. So wishing you the best in capitalizing your business. Again, I'm signing off. Thanks again.